If you've watched this program regularly, you know that we don't have many analysts on this program. Not always sure that they're coming at things in the right way. But there is one analyst who we've consistently put on this program, and he studies the banks. Well, this particular analyst is back with us today, and do you know what he's saying today? He says, don't touch bank stocks until October. I don't know why he's chosen October, but that's what he's saying. Don't touch bank stocks till October. The man is Dick Bove. He's with Rafferty at Capital Markets, banking analyst, and he's the analyst who's on our program. Right, why do we stay away from bank stocks until October?
Well, I think there are a series of reasons. First one, Stuart, is that business is miserable, right? In other words, banking business at the present time is reflecting the fact that there's weak growth in the economy, which means that there's very weak loan growth. There's also a high degree of probability that loan losses are going to go up significantly in this quarter, and I think they'll continue to go up through the remainder of the year. So reason number one is we want to see if the economy is going to be much stronger through the summer or in the second half, which would reduce, if you will, the loan losses and get loan volume to increase. Second reason is the budget. I mean, basically, the United States government is broke. I'm a very strong fiscal conservative, so I think the United States government is broke. I think that it's unclear to me where the money is going to come from to pay for an increase in the deficit, and I think that, therefore, we need to see some much greater clarity on the tax bill before we get very aggressive on any stock, but certainly on bank stocks.
Okay.
So those are two of the core reasons. Okay,
now, you were correct right after the election in saying those bank stocks are going to go straight up, and they did. Some of them are up like 18, 19% just since the election. Why not sell now, take some of your profit, and walk away? Why not?
Well, you could. I mean, I wouldn't disagree with doing that. You know, it was on your program about 6 weeks ago that I said that those bank stocks had peaked and they're not going to continue to rise, and that the stocks are going to go down throughout the summer. So if you're a good enough trader and you have a lot of confidence in what you feel, you know, I see no reason not to sell and then come back. If in October, you know, we've got a tax bill which is in good shape, we have an economy which is stronger, and we're seeing, you know, an improvement in loan volume and a reduction in loan losses.
What about, there's an ETF, it's called XLF. I understand that to be a basket of financial and bank stocks.
Correct,
and I use that as a proxy for the financial sector. Is that a good proxy to use?
Yes, I think it's an excellent proxy. It's what most of the, let's say, more sophisticated investors use. It's a little bit more aggressive than, there's another ETF called KBE, which you could also use, which is not, if you will, is leveraged as the XLF. But the point is that either one would be a good way to play bank stocks.
All right, Dick Bove, we hear you, and thanks again for coming on the show. Much obliged to you. Thanks a lot.